Hello, I'm Simon Wardle and welcome to the Velocity Money Talks webinar series. Velocity is a free program set up to help growing businesses benefit and do exactly that. This is one of a series of 5 programs that we've put together with the high street banks to help you answer everyday questions that are relevant to your business. With over 25 years in finance myself, I hope that we're going to get to grips with many of the issues that we hear you ask every single day. So we're here at Colworth Park in Bedfordshire, a centre of innovation and excellence in its own right. So why don't you come and join me and meet some of my guests. Today then, I'm joined by Peter O'Gorman, Regional Director of Santander Bank, and he's going to talk to us today about the importance of a good business plan and what it will mean to the bank and the effect that it can have on the funding for your business. Peter, thank you for joining us.
Thank you for asking, Simon.
I'm a new business, right? I've got this great idea. I've come to you for some money. Yeah. What are you looking for from me?
Okay, well, fundamentally, the most important part of a business plan is the individual that we're going to be lending to or is going to be running the business. There are 2 types of businesses. Obviously, you've got the startup and you've got the more established business, and the business plans are different for both of them. With a startup, we would expect to see an awful lot more on the market research, whereas with a more established business, we would want to see tangible evidence of what they've done over a period of time to demonstrate that they can actually run the business successfully.
So what sort of market research might you expect a new business to do?
Well, going through various databases that would demonstrate there was a market for the product or for the service, competition, research on the competition, who else is doing it, who else is offering that particular service. It would be particularly good to find a unique selling point. So what is it that you bring to the market that other people aren't currently offering, because that's what will give you the edge.
And how might you expect a business to demonstrate that to you other than what they've written on a piece of paper?
Well, statistics, to prove the market, if they've got actual questionnaires that they've done with people, if they've got written evidence that proves that somebody's actually going to buy their product, if they've got contracts already in place, that people are actually going to trade with them, then fantastic. Otherwise, it's quite speculative. So there needs to be tangible evidence that somebody somewhere is going to buy the product or service. We can also reference internally within the banks other customers that do the same type of business, and whatever's written in the business plan, if that's similar to what we're actually experiencing from existing customers, then that actually corroborates the information they've put in the plan. So it's all down to experience, a lot of it's down to gut feeling, a lot of it's down to what we know about sectors. All banks have got a different stance on certain sectors. Some are more risky than others. All I would say is in every sector you've got great operators and you've got some of those that shouldn't actually be in business.
I've long held the view, actually, that business plans are a peculiar thing. If there's nothing in the business plan, nobody will lend you any money. It almost shows that you haven't thought about your business. On the other hand, you can write War and Peace, and there's so much in there that it almost can't be read. But to my way of thinking, one of the great things about a business plan is that the writing of the business plan focuses your mind on where your business is going. Would you agree with that?
Correct. You shouldn't write a business plan just for a bank. It should be written for you. You shouldn't write it and put it in the top drawer and leave it there and review it in 12 months' time. It should be a live document, a working document that you adjust as things happen. A curveball might be thrown at you when you first start your business and you're thinking, right, well, that's not going to work, so I need to tweak it to make sure that it does work. So a business plan, first and foremost, is written for you as the individual business owner. When it comes to getting the bank to understand your business plan, you're telling a story. So you need to make sure that they understand who you are, what the product is, what the service is that you're going to provide, who are you going to provide that product and service to, how are people going to pay you, what terms are you looking to introduce by way of payment terms. We talked about cash flows, operating budgets. You will need numbers in there to demonstrate that this is going to work. The banks will do sensitivity analysis. So if there's a 5% spike in turnover or it falls off by 30%, can the business continue to trade? And it's very important that you do the sensitivity analysis yourself to make sure that it is going to be a viable business plan, which is ultimately a viable business. So what I would say is that the key point of any business plan is focusing on your unique selling point. What is it about you that makes you special, that makes your business different? What is it that you're going to do that nobody else out there is going to do? And you've got to get across that message as clear as possible.
Clearly, some people will come in and you'll almost warm to it as a business. There's going to be particular features that you think are, much stronger on that business plan. Just talk me through what makes a good business plan. What warms it to you?
Okay, well, the individual is the key. The quality of the management team is so key. If you're a sole trader, you do it on your own, we will be looking for your experience, your age, how long you've actually been trading or you've been doing this, what your qualifications are. We want to see a really good CV as part of a business plan. That would give us so much information. So if it's a partnership or a limited company, we would expect to see a CV on all the key individuals within that company. So if you've got a financial director in there, where has that person worked before? What experience have they got? And if it comes across that this is a really robust management team, that's a really good starting point, because then everything else is dependent upon the quality of that team. Cash flow, sales, marketing, recruitment, relationships with unions, relationships with staff. So you get a feel for that pretty much by understanding the makeup of the management team in the first instance. And then you're into the other parts of the sector. The sector is very key. Every bank will have its black sectors, red sectors, amber sectors, green sectors, and you've good operators in all those sectors. So what we will be looking to do is to understand, has this management team, has this individual actually got the ability to make this work, to drive the business forward, to generate the income that will repay the facilities that they're obviously looking for.
One of the great mysteries of any business plan is this thing called the cash flow forecast.
Yep.
Yeah, it's a little bit like sticking your finger in the air and guessing how much business you're going to get.
Yep.
What would your tips be to a business in terms of getting a cash flow forecast right and accurate?
Right, well, firstly I would say seek professional help. If you're able to pull a cash flow forecast together yourself because of the experience you've had either in college, in university, or in a previous organisation, then fantastic. But if it's something you're not familiar with, then organisations such as Velocity, then they are absolutely perfect to help guide you through that process. One thing a bank will be doing will be analysing the detail in the cash flow. So if your business is a seasonal business, we would expect to see peaks and troughs of when the cash is going to come through. We would also, again, compare it with what we already know from businesses in the same sector to make sure it's realistic. The other thing is we look at the breakdown of the income, where it's coming from. Is that realistic? Is that sustainable? You would look at all sorts of factors, the political factors, social factors, economic factors, and is this all actually sustainable?
And typically, how far ahead would you expect a business to expect a forecast?
I have seen cash flow forecasts go up to 5 years, and if it's a start-up, I would say that's probably wasting your time, because aspirationally you may want to get there, but 5 years is a long time, and obviously a lot can happen in that period of time. So I always like to see at least 2 years. The first 12 months are the most important. The longer you go out, the more it's subject to the probabilities of so many different things happening. But 12 months definitely, 24 months is ideal. And if there's a 5-year cash flow in there, then at least it demonstrates to the bank aspirationally where you would like to see that business in 5 years' time, 3 years' time, 5 years' time, whatever.
So for the purposes, let's say, of somebody who's never done a cash flow forecast, yeah, just itemise for me some of the typical lines of expenditure and items that you think would make up that forecast.
Okay, well the first thing that we will be looking at in the business plan from the Word point of view, and the first few pages about how they're going to run their business, where the location is going to be, what the premises are going to be like. If they're going to be requiring premises, renting premises or buying premises, then we would expect everything in the written part of the business plan to have transferred into the cash flow. So typically in the top part of the cash flow forecast you would expect to see income coming in from sales, then you would have the cost of goods sold coming out afterwards, then all the items of expenditure such as rent, such as loan interest, such as rates, utilities, wages, VAT, all of those items of expenditure are going to be cross-referenced back into the main body of the business plan to make sure what you've got in the main body of the business plan actually transfers into the numbers, and the banks will be using that to make sure that you've caught everything within the cash flow forecast, because if you've left something out it can make a fundamental difference to your business. The bottom line of the cash flow forecast will actually demonstrate how much funding is required, and then the bank would give you advice as to how that funding should be structured, be it by overdraft, be it by loan, or be it by other products and services.
So without doing that and without itemising and segregating it down, are you suggesting that it's almost impossible to actually ever go in and know what the purpose of your fund requirement is?
Yes, very much so. You're kind of guessing and it's finger in the air. What I would suggest is it's always good if somebody gets a set of accounts on any business, and then you can look at the items that other businesses have put in their profit and loss account, and making sure that you've got all of those headings covered within the cash flow forecast. But if you don't do that, then it's going to be incredibly difficult to understand, one, all the items within your business that you're going to have to pay for, and that's when the curveball comes in at the end and you're going to get it hopelessly wrong.
You're suggesting that without all of this itemisation, without giving proper thought to your cash flow forecast, it's nigh on impossible to approach a bank and ever get a specific purpose for the loan?
Yeah, well, you've got to demonstrate in the business plan as to why you want the money. Is it to grow the business by acquiring more equipment so you can make something? Is it a vehicle so you can transport your goods around and deliver them to customers? You know, what exactly is the money required for? Is it just a working capital facility to help the cash cycle while you're waiting for people to pay you? What we wouldn't want to see is 3 directors fancy a loan for 3 posh cars just because they're directors of the company. That's probably not relevant to the business. Very nice to do it, but not relevant to the business. So the purpose of the loan has got to be relevant to make sure that it's actually driving the business forward, to generate the income, which generates the profit, which helps repay the loan. And again, the purpose needs to be over an appropriate period of time. So if you're buying an asset like premises, 20 years. If you're buying a vehicle, 3 to 5 years. If it's just a working capital facility, such as an overdraft, well then that'll be 12 months, and that will be demonstrated in the cash flow forecast.
Other big factors, of course, that always affect any cash within the business are debtor days, i.e. how good you are at getting your money in, yeah, and how you offer your credit, and of course whether there's cash or whether everything's on an invoice.
Yeah.
How do you gauge that, and what tips can you give a company towards keeping cash within the business?
Yeah, well, everybody knows the phrase cash is king. If you run out of cash, irrespective of how profitable your business is, then you're going to have issues and you're going to have problems, because you won't be able to pay wages, you haven't got a happy workforce, people won't work for you, then the business gets into trouble very, very quickly. So if you can elicit credit from the people that you're actually getting your supplies from, fantastic. If you're a startup, it's highly unlikely that people will offer you credit terms on day one. They would want to see a track record, so the chances are you'd have to pay cash up front before they would give you the goods. Only when you develop that track record and develop a credit rating will companies then afford credit to you. As far as the debtor days are concerned, again, the same thing. If you're going to be dealing with somebody, how do you know you can trust them? How do you know they're going to pay you in 30 days? How do you know they're going to pay you in 60 days? But you've also got to gauge it with what else is going on in the industry. If they're getting favourable terms from somebody else, then why should they buy from you? And it's not about cutting your margins. I'll be the cheapest person, I'll sell it cheap, because very quickly, again, you will realise you're not going to be making any money. And just because you've got cash in your pocket doesn't necessarily mean you're actually profitable. The two things are very distinctly different.
And what about the issue of security and when a bank will lend, and how you shore up the debt, or what you're looking for from a client too before you will lend him money?
Okay, great point, because if you're a startup and maybe you're a young person, the chances of you having any real tangible security is probably very remote. So I would say in those cases the bank of mum and dad or relatives who might be able to help that business start is probably the most appropriate way, rather than putting houses up as security. The more established businesses, the banks will look to the quality of the business first and foremost. So the strength of the balance sheet, the strength of the debtor book. Is that something that the bank can take a mortgage debenture over the assets of the company? So therefore, if anything goes wrong, the bank has got step-in rights to take control of the business and realise the assets. So there are banks that will lend money, cash flow lending. Not all. They've all got different policies and depending on the sectors, etc. But I would say that don't think that security is a barrier to you getting bank funding. As long as the business is robust, the sector is robust, you can demonstrate that you can run the business and you can make a profit, you've got the ability to repay the debt, then there's absolutely no reason why banks wouldn't consider an element of unsecured lending, or a combination of both, partly secured, partly unsecured.
Excellent. Peter, it's a fascinating subject. It's probably one of the most important core foundations of any business. I thank you for joining us today, and I believe that you're going to be answering questions live on the webinar. So thank you very much indeed for your time and all of your input. Thank you.
Perfect. Thank you, Simon.
So that concludes this particular subject, and remember that this is one of 5, so be sure to view the others. There's going to be a live web chat now, open for about 15 minutes, where you can talk to our panel of experts, or of course you can interact with us on social media or directly via email, and all of the contact details are shown on the screen below. Our thanks again then to Colworth Park for hosting us. Remember that Velocity is here to deliver all manner of business help and guidance right the way through to one-to-one mentoring. We hope you found this series of interest, and again we thank you very, very much for joining us. Goodbye.